Money supply increase is what causes the price of nearly everything to rise over time. When we overlay the S&P 500 on top, we can see that relationship with the stock market as well. Over the long run, as more money circulates, stock prices generally rise. That's because companies can pass on higher costs to consumers, their revenues grow, and so do their share prices. In other words, stocks act as partial protection against inflation. However, this relationship isn't perfect. There are periods when the money supply grows while markets decline. This chart shows the relationship between S&P 500 and the money supply more clearly. When the line is rising, the stock market is growing faster than money supply. When it's falling, money is expanding faster than market wealth. You can see this ratio dropped during the 2001 and 2008 recessions when stock markets crashed even as money supply kept rising. But more importantly, it's what happened between the 1970s and 1980s, a period when this ratio fell for more than a decade. When we look at what the actual stock market did in the 1980s, it was making new all-time highs. But once we adjusted for the surge in money supply, the stock market performance actually still went down. So in real terms, the market wasn't creating much new wealth at all. That's a perfect example of a reverse stock market crash. So what caused it back then? The US was hit by runaway inflation and an oil shock that sent energy prices soaring. To keep the economy afloat, the government printed more money, which only made inflation worse. It wasn't until inflation was finally brought under control that the real market growth returned. Today, this doesn't seem to be the case. The S&P 500 relative to money supply is now rising to its highest level since the late 1990s. That means investors are, for now, creating genuine real wealth, not just inflation-driven gains, much like what we saw during the economic boom of the 1990s. Inflation also remains contained, far from the runaway levels seen during the 1970s. So if inflation remains under control and the economy stays resilient, the stock market could continue rising faster than the expansion of money supply, creating genuine real wealth for investors. However, if inflation begins to accelerate, driven by more rapid monetary expansion or external shocks, and the economy starts to weaken, the story could shift quickly. In that scenario, the ratio of the S&P 500 to money supply could drop sharply, signaling a market downturn or even a reverse stock market crash.